a team of economists at the ECB put out a note back on Monday, officially on the ECB website, that said a lot of the stuff that you and I have been talking about for a decade. That's what they're alluding to, is that there's counterparty risk. And that counterparty, these big banks have this massive exposure against higher prices because of the way they manage their books, and that actually is a threat to the financial system.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for May 19th through May 26th, 2025, while supplies last. First this week, we feature backdated 1-ounce gold American Eagles at just $89.99 over spot per ounce. 1-ounce 2025 silver American Eagles are just $4.99 over spot. Next, we have 10-ounce silver Royal Mint coins at just $2.99 over spot per ounce. The 10-ounce Britannia, 10-ounce Royal Arms, 10-ounce Little John, and 10-ounce Merlin are all 4.9s fine. And we have a very limited quantity. Again, they're just $2.99 over spot per ounce while supplies last. Next, backdated 1-ounce gold Canadian maples are only $69.99 over spot. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.
Hey everyone, this is Elijah K. Johnson with Liberty and Finance. And back with us today is our good friend Craig Hemke from TF Metals Report. Craig, thank you so much for joining us today.
Elijah, my old friend, it's always nice to sit down and visit with you. Thanks for reaching out.
Well, it's great to have you today. I did want to get your take on the markets. First and foremost, with gold and silver, it seems like rallying again here. We're recording this on May 22nd. We had a pretty good rally yesterday. And also, it seems like the stock market may be falling again, with all the debt issues and all of that. So your perspective on the state of the markets right now.
Well, let's start by, gold is not just a dot on a screen, right? I think a lot of folks, when I read Twitter, or even just see people on my site, sometimes get confused with the futures price, which is just, a price like anything else. It's just a dot on a screen traded by algos, but yet it's a physical commodity. And that physical commodity is what backs up all those futures contracts. And we had a note, and it's not like you could say it's not like the head of the ECB came out, in a press conference and said, oh, we got to be careful about the counterparty risk, in all these gold derivatives in London and New York. So it's not that, but a team of economists at the ECB put out a note back on Monday, officially on the ECB website, that said a lot of the stuff that you and I have been talking about for a decade, Elijah, about, the leverage that's supplied within the futures markets and the forward markets, where 1 ounce gets hypothecated and rehypothecated, and you don't know how many physical ounces back up, or how many contracts there are, or how many digital ounces there are versus each physical ounce. And that's what the ECB economists were warning about. And so when you look at gold just as a dot on a screen, and you go, well, it's, every time it's been this far above the 200-day moving average, it eventually pulls back, and you start talking about, some arbitrary price of, 2,800. It's almost like some of these folks try to talk that into existence. The chart shows a fundamentally sound market that just keeps moving higher, in a pattern of, kind of two steps higher, one step back. We pulled back last week in price to the 50-day moving average and held it for 3 days, which is exactly what happened in early April after the Trump's tariffs announcannouncements. And so I think this notion that gold's going to swoon through the summer, and pull back, and it's, all the way back under 3,000 or something for people that are waiting to buy the dip. I don't think that's coming. I think the opposite's true. I think we're going to rally beginning as soon as the calendar flips. Heck, it looks like it's already started. And I think new all-time highs are coming sometime in the next 60 days.
Now, with respect to what the ECB stated, I know I was reading some interesting things they were saying about kind of investing in gold here, but you were saying actually that they reported that there could be more paper ounces than physical ounces there available.
Yeah, that's what they're alluding to, is that there's counterparty risk. And that counterparty, these big banks have this massive exposure against higher prices because of the way they manage their books, and that actually is a threat to the financial system. I mean, these are all things that, again, I'm like reading this going, is this guy a subscriber to my site? I mean, we've been talking about this for 10 years. And so we'll see, just that, what it reminded me of, because gold, there are a lot of things that have been driving price higher this week, right? The downgrade of the U.S. debt late last Friday after the markets closed, spiking long-term global interest rates, this passage of this big, beautiful bill that doesn't have any deficit or debt reduction at all. People thought, austerity and, they're going to balance the budget and Doge and all that's out the window. Okay, and so there's a realization now that's building that all that is out the window. And that's what the bond market is seeing that. So there's a lot driving price this week. But when I saw that, and I've seen the rally since, it kind of reminded me, remember back in about Valentine's Day, Elijah, there's that article that appeared in the Financial Times about delivery delays in London. Remember that one? And we already kind of knew this was happening. There's this big wide spread between spot and futures, and metals going all over the place. And they're talking about it was related to tariffs allegedly. But when it got codified, if you will, in a mainstream source like the Financial Times, everyone, whoa! It caught like mainstream hedge funds and financial advisors and other mainstream sources kind of off guard. Like, wait a second, I had no idea. How is this happening? We didn't know this, but here it was, the Financial Times. And I kind of thought, in a similar sense, that's what that ECB note was. I mean, a lot of us, that follow gold intently and discuss it, and have for years, talk about that risk, because it's a fractional reserve system. And the risk that if you just keep deleting the physical, what did China import last month officially? I mean, unofficially, because it's all mainly, through shades. Not China's buying the PBOC. It's just everywhere. It's like 100 some odd tons. If you keep taking all this metal out from underneath the system, it forces a deleverage. And so anyway, like I said, I think that ECB note was just kind of a slap in the face, kind of like that article in Financial Times was. And that's kind of helped spark all part of what was driving gold higher this week.
Does this really confirm what a lot of, you've been talking about for so long about manipulation in the markets? Is this what the ECB is kind of alluding to? Is this actually precious metal manipulation, or is this different from any other commodities, or what happens in any other commodities here?
It's pretty clear to me, watching this stuff for 15 years, that there are hands that move price at certain points, both up and down. I mean, you can go back a couple years ago when the banks were actually getting net long in silver, and it was the hedge funds that were short. And you can see these things, because especially in silver, where it's a tiny market. But I don't think, in this case, I don't think that's what we're driving at, Elijah. It's just the structure. If you want to just paint it as normal business operations, we don't make directional bets, that the banks have, in their vaults, whether they hold it themselves in London or for somebody else, and then they hedge that, right? That's what everybody says, they hedge that on the futures market versus a physical position in London. At the end result of that, how many times have those same ounces in London been hedged and sold forward? Because again, the London tries to tell you they got all these tons, in their float, and what saved them back in March? Well, central banks coming in and leasing gold in the market. Well, then how many times has this happened in the past? And how many times have those ounces been released, and reloaned? And it's this kind of like not necessarily like a pyramid scheme or a Ponzi scheme. It's this fractional reserve. Okay, there's a certain amount, there's a certain float, there's a certain amount of ounces that backs up this whole pyramid of derivatives on top of it, futures contracts and forward contracts. And as you shrink that supply, it just stretches the leverage even farther. And it's like, remember when I wrote my macro cast this year, we always do a call and talk about what was in there. And I always tell you, I write those for myself so I can go back at the end of the year and go, what did I get wrong? In 2024, I thought, well, gold will probably go to 2,300 or so, maybe 2,400, which was still going to be a good year, but it just kept going. And now it continues to go this year. And I thought, what did I miss? I think the main thing I missed, and this is noted in that ECB piece from earlier this week, central bank demand and constantly being on the bid is depleting that Western supply that underpins that system. It's 34 or 3,500 cumulative tons of net demand from central banks in 22, 23, and 24. Well, unless they're leasing it back, and most of them aren't, then that's just metal that's just, shrinking that bottom part of the pyramid. And that's what the ECB is warning about, that eventually that creates really a systemic risk to those banks. And they're urging other banks be paying attention to this so they don't get caught flat-footed if, within that, this counterparty daisy chain of all their different obligations, that there aren't stresses coming for the banking system there and here.
And you mentioned how if you just look on a technical level, maybe where we'd be headed for a pullback here, but maybe things have fundamentally shifted. If, the banks are, if it's true that the banks are, short and that gold has been rehypothecated, and we also see just China accumulating so much gold at this point. So your thought is probably things have fundamentally shifted here.
Right. That's the thing. That's what the TA, and just the regular, professional traders and stuff are missing. It's not just a dot on a screen. Okay, it's not just, the scroll across the bottom of the screen price that you see on CNBC. It's this physical commodity that underpins all of those futures that are used to determine that price. That's what's getting depleted. That's what's becoming more and more scarce. And the demand for that physical commodity is what's doing it. And so when all these folks are sitting there, and they come up with all these, it's like all this discussion last month about, or even earlier this month, I guess, it's a crowded trade. No, it's not. I mean, by what definition? I mean, even the most recent surveys we see, 5% of all financial advisors have their clients with even just a tiny position in the precious metals. How's it crowded? Even by the Commitment of Traders reports, as of last week, we had the smallest cumulative speculative long position in gold since February of last year, before price even broke out. So how is it crowded? Or is it crowded because, price is in the 3,000s, so it must be crowded? You know what I mean? Are you trying to talk it into it's overbought. Well, by what measure? The monthly RSI maybe, but everything else, especially after the pullback, is not overbought. So what I think is going to happen now, gold rallied like crazy as the dollar was falling. From February 1st until middle of April, I think it was April 22nd, it bottomed out at about 98 on the dollar index. That day, gold hit 3,500. Well, then it bounced. The dollar, inevitably, it's not like the dollar index is going to zero. There's going to be bounces. It got up through its 20-day. And on my side, we're like, okay, now we'll watch because it's going to go to its 50-day. And there's all kinds of resistance at about 102, where the 50-day moving average was, a downtrend line, horizontal resistance, all that stuff. And it's exactly where it failed. And it rolled down, never got above the 50-day, took out the 20-day early this week, and now it's a little bouncing again as we record this on Thursday. But what if the dollar index now just continues down because all this profligate spending and no debt reduction and, concern, maybe Japan comes in and sells treasuries because they got to support their own bond market. So they sell treasuries, take those dollars, sell those dollars, and buy yen so that they can go support their own bond market. What if the dollar index goes back down to 98 and then keeps falling over the next couple of months? Goes to 96, 95. You think gold's not going to rally? Of course it is. Like I said, the last time it was at 98, gold was 3,800. So I think, or 3,500. I think what's coming over the next couple of months is going to catch a lot of people by surprise because, again, they think it's just a dot on a screen. It has to correct. It's got to pull back. It's overbought. It's a crowded trade. And when it goes to 37 or 3,800 over the next 2 months, it's going to catch everybody by surprise. And then, and then it'll be due for another pullback.
Now, we've been talking a lot about gold here. What about silver? We do see, a huge gold silver ratio, 100 to 1 right now. Your take on that? And at the same time, we still see strength in silver. It seems like holding up above that $30 level, and actually 32 seems to be pretty good support as well. So your perspective on that?
Yeah, it's been in a box for about 5 weeks between about 32 and 34. And this happened as well back in, I think it was February, and it was in a box, a $2 range for about a month. Then finally, then granted, the dollar was falling, right? Dollar really started to fall at beginning on about the 1st of February. So, there's other things that drove this, but it began to move up. For a short-term technical indicator, the 20-day moving average moved up and bullishly crossed the 50-day moving average. That drove a lot of momentum traders with the falling dollar, and it rallied $4. And it went from 30 to 34, 35. Well, we're sitting at that spot right now. It's starting to move up. The dollar's starting to fall. And that 20-day is like 10 cents away from crossing up. It becomes kind of self-fulfilling. If it can rally, price can rally. Well, it's only the last 20 days of price that's in that moving average. So you kick one out, you put the new one in, and thing starts to move higher. So we're about to get that cross again. I really want to trade some silver. I want to venture into the COMEX casino and buy some calls. But as long as we're still in that box, going to stand by. We get that little breakout, not only above 33, but maybe more important, 34, and hold there for a day or two and get that bullish cross of those short-term moving averages. I think we go to 35, 35.50, those old highs, and then through there, 38, 39. So then to get back to your premise, the first part of your question, gold-silver ratio maybe stays at 100. Gold catches everybody by surprise over the next 60 days and goes to 3,800. And silver goes to 38, 39. That would be the kind of the way I see that playing out.
Now, it seems like in bull markets, silver usually catches up a little bit late in the game, right? In this bull market, we're seeing central banks buying a lot of gold. We're seeing the Chinese public buying a lot of gold. We see, so in that case, do you see a demand for silver actually coming? And who's going to be buying it at this in this bull market?
My experience with silver, now again, this dates back to the last time it really took off, in 2010, 11. It's price is kind of self-fulfilling in creating its own momentum. All the traders, and everybody that wants to, really profit from it are like what I just said, like me. I'm not going to do anything until it takes off. I'm going to wait till it takes off. I'm going to wait for it to break out. And then everybody, once it does, then everybody starts to rush in and it creates its own momentum to the upside. That's how it went. We went from 18 to 48 in 100 days or something in 2011 of this accumulation. Well, now it's 32 and that's good. 35, 38. And it just builds on itself. And so it tends to just sit there. Like I said, in this box like it was in February and in this box like it is now. And then it takes off on its own. I still, my forecast this year, I thought we could get maybe up 40 or 41 and then pull back, finish the year 37 or 8. I was like, geez, I'm waiting for it to go to 80 like I read somebody on the internet said, right? And so when I say this, there's going to be people in your comments that say, I can't wait any longer. I've been waiting long enough. What do you mean next year? It's always next year. I think it's next year. So everyone, hang in there with me on this. If you want to really get that momentum going again, right? We need just more than you and I talking about it. And we need the institutions, we need the family offices, we need the hedge funds, we need everybody starting to pile in and really kick off that momentum train. This happened in gold last year. It broke out on the quarterly and the annual chart. Okay? Got out, got above, and that's got everybody's attention. And gold's now gone from 2,000 and 2,100 or so to what, 3,300. So it's rallied 50 some odd percent. Okay? I was hoping we'd get that annual chart breakout at the end of last year. We might even have talked about it in kind of a year. Watch silver. Can it get above 31, 32 and, post its highest annual close? and it didn't. Pretty good chance it's going to happen this year. So if that happens, if I'm right, we finish the year, even if it's just 35 or 6, anybody can look at then this really long-term chart and go, whoa. I mean, there's still trades within the year, a wick sticking out the top of the candle that go to 48, back in 1980 and 48 back in 20. But in terms of finishing the year at a breakout, and again, the longer term chart, the better, quarterly and annual, that's the one everybody will see. That's what will really get a lot of people's attention as we go into next year. So could happen this year. Look, I'm not rooting against it by any stretch of the imagination, but I think the silver, if for the people that say, oh, it's going to 80, 100, all these numbers, if you're going to get a look at that, it's going to come after you get some big, massive indicator like that kind of annual breakout. Most likely, that's going to have to happen first.
And if our viewers are interested in learning more, they can go to tfmetalsreport.com. Can you tell us a bit about that and any last thoughts you had?
I allude to the years this has taken off my life of watching this stuff, Elijah, for 15 years. But it's been fun, and we'll do it a few more. Every day, analysis in the morning, a podcast in the afternoon. Try to keep everybody up to date on what's going on. I'm kind of their eyes and ears of the world. But it's not free. I mean, I get paid for it. It's $15 a month. But the community is great. People from all over the world, all political stripes, and we all try to get each other through this. I mean, the key, I'll just tag one last thing into this. When Trump came into office, and look, without getting into the politics of it all, there was a belief, though, that, okay, Doge, cutting wasteful spending and all this stuff, and they're going to balance the budget. And I'm like, what? No, they're not going to. It can't. It can't. At this point in the debt game, you can't. And so there's a realization now in the current time. People are going, you know what? God, it's not going to happen. It's just, the train can't be stopped at this point. These are the kind of things we try to stay ahead of. So you're on top of the longer term trend and ahead of it and stacking metal for what is obviously a mathematical certainty of what's, coming at us. And that's all the stuff that, we're not just out there trying to swing trade and stuff like that. We really rarely do that on my side. It's more big picture stuff and keeping people up to date. And I encourage everybody to check us out. It's just that tfmetalsreport.com.
We'll really appreciate today, Craig, and things are definitely getting exciting. I know you say it's always next year, but I think, if you look at the last year, we've had huge moves in the precious metal market. So it's been exciting to track this with you, and looking forward to the next time, Craig.
All right, brother, take care of yourself.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for May 19th through May 26th, 2025, while supplies last. First this week, we feature backdated 1-ounce gold American Eagles at just $89.99 over spot per ounce. 1-ounce 2025 silver American Eagles are just $4.99 over spot. Next, we have 10-ounce silver Royal Mint coins at just $2.99 over spot per ounce. The 10-ounce Britannia, 10-ounce Royal Arms, 10-ounce Little John, and 10-ounce Merlin are all 4.9s fine. And we have a very limited quantity. Again, they're just $2.99 over spot per ounce while supplies last. Next, backdated 1-ounce gold Canadian maples are only $69.99 over spot. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.